Welcome to episode 3 of the Financial Engineer Talks, TFE. It's recorded on February 15, 2025. I'm your host, Muhammad Murad, the investment manager for serious investors and families who want to employ and protect their capital for safe growth and returns. This is where we bring together global insights and actionable strategies to help you create, preserve, and grow wealth for yourself and your bloodlines. If you're passionate about building a lasting financial legacy in an ever changing world, this podcast is for you. In today's episode, we will explore a myth in the financial markets that cryptocurrency is immune to geopolitics and macroeconomics. In the second topics, we will discuss mistakes early investors make when they are relying on financial news. This can be misleading. In the third topic, we will be talking in the section about finance for you and your family living on debt. And the fourth, we will be selecting the best article from the Economist of the week, and it's titled Until Crypto Scams and AI Investigations. We will analyze specifically the case study of the pig butchering. As you heard it right, pig butchering. And the topic about AI and its role in investing, we will be discussing how it's helping the financial analysts to take better decisions and how new funds are integrating AI into their analysis. Then, in the section where we discuss words to invest by, we will be talking about is in investing, what's comfortable is rarely profitable. A statement by Robert Arnott. So, let's get started. In the section on the myth today, we will be discussing for the next 8 minutes how cryptocurrencies, we used to think that cryptocurrencies are built and they are immune to geopolitical events and macroeconomics. Yet, with what we have been seeing for the last 5 years, there is a lot of correlation that is happening between cryptocurrencies and the macroeconomic events, and even geopolitical events. In a recent case study, just not to go back a lot in the history, when tariffs has been implied by Trump on Canada, on Mexico, or even on China, cryptos has reacted negatively to that news. One can think, why is that? Why did crypto react negatively to the tariffs when we are thinking it's an independent ecosystem from the financial markets? Just in that way of thinking, one can also start to think what happened when the war between Russia and Ukraine took place at the beginning of 22. At that time, cryptos rallied when it's just a war. Also a question to think about. When inflation starts going up, we tend to think that crypto is an independent ecosystem from the financial markets. Yet when inflation goes up, crypto sometimes goes rally in its bull cycle and sometimes drops or crash in its winter cycle. And the question is, how is crypto related to discussions on inflations? How is crypto related to discussions on tariffs? How is it related to discussion on interest rate? When the interest rate goes up or the interest rate goes down, why would crypto react to that? Whether it's positive or whether it's negative? And how do we position ourselves given the forecast of what the macroeconomics are expected and what are we trying to achieve with that? It's always to protect the capital and grow it with time. Now, to keep things simple, always remember that heavily on earth, we still rely on fiat currencies, whether it's the euro or the British pound or heavily the US dollars, which is still considered the best strategic reserve around earth. Now, when we think about it this way, and we also know that crypto is just a mere technology software, you can call it a technology company, developed by companies around the world to perform certain actions on the blockchains, whether those actions are ledgers or transactions or transfer of funds. These are just technological innovations. Now, or disruptions, if you want to call them. Now, institutes look into crypto as just another technology investment. For the retail investors, they think about it as a currency, they call it a coin, you can call it whatever you want. But by the end, it's just a software that we invest in. This software could be successful or it could be a failure, depending on its utility and depending on the community that it could build around it. When you have an amount of money circulating between people's hands, this amount of money could be allocated to any type of asset classes. It could be bonds, it could be stocks, it could be real estate, it could be art, it could be cars, it could be their expenses, it could be whatever, it could be remaining in cash or other fiscal tools like the interest rates. They would start being following the inflation cycle as well. And here let me, because this is a tricky discussion about what's the relationship between inflation and cryptos. If we want to think that cryptos is a safe haven, especially bitcoins, and I'm going to give you a case study that was done by one of the hedge fund managers when the inflation started rallying 2 years ago or 3 years ago, exactly in the year of 22. Many hedge fund managers moved 2% out of his portfolio into cryptos. And the rally of Bitcoin at that time, at the beginning of the increase of that was only for a brief period of time. At the beginning of the increase in the inflation cycle, this is when Bitcoin rallied because people went to it as a store of value against fiat currencies. Now, if you notice afterwards, that was a smart move. Then afterwards, when the government started using its fiscal tools and specifically the interest rate, this is when they increased the interest rate, the Bitcoin dropped and the inflation started dropping again with it. And why would that happen? Just as simple as a point where, remember, everything goes up and down, even inflation. It has its own cycle, it goes up and down. So at the beginning, people will start rallying or will start taking their capital from the fiat currencies, which is dropping in value, into a store of value. It could be gold, Bitcoin, or whatever. And then when the inflation start taking controls and the interest rates start giving more value on, remember, lower risk, higher yield asset classes like the treasury bonds, people will start removing those monies from the Bitcoins or other asset classes and go into treasury bonds. And this is how the cycle would keep continuing. Now, when we say a market has crashed and trillions of dollars has disappeared from a market or from an asset class, in reality, the money doesn't evaporate. It just moves from one asset class into another. And a savvy investor has to know where the money would be moving. The money never sleeps, as we always say. It moves from one asset class to another, from a higher risk asset class, low returns, and to a lower risk, higher returns asset class. And like that, it keeps circulating between all the 7 asset classes. Just to give you a hint on them, we speak about always cash. Cryptos is one of the cash forms because it's easy to transact with. Cash, bonds, equities, real estates, collectibles. When we speak about collectibles, we're speaking about arts, we're speaking about watches, luxury cars, and stuff like that. And alternative investments, this is when we're speaking about hedge funds that are investing in mines, farms, and stuff like that. So this is how the money is going to be always moving between all those asset classes. And when it is within an asset class, it starts preferring certain sectors. This is another discussion for another day. So this was our 8 minutes or 10 minutes on the first section of today, which was debunking one of the myths where we speak about crypto as independent from the financial market, yet it is not. The second topic, and this is an exciting topic, guys. One of the common mistakes early investors do, and this is the over-reliance on news. You know, they always say, I heard on the CNN or on the Fox News or whatever is the news that they want to follow that Facebook is doing good or Facebook is doing great. Rarely that they think that these news channels and media channels are traps for the retail investors, and they are highly paid by the institutions. They are highly paid by the institutions to drive certain agendas for the institutional traders. Now, let me give you a little bit of a more inaccurate example. And this happened with Facebook in the year 2024, exactly in April 2024. You can go in and check it on the online. Just check April 2024. The stock is Meta, which is Facebook. You can check exactly what were the titles on Reuters and other headlines. And the specific title were, to read it here from my notes, it speaks on Reuters. The headlines was Meta sparks tech sell-off as AI splurge spooks Wall Street. It's a very sophisticated title by one of those financial writers. The idea is they are trying to create fear for the investors in order to sell the stocks of Meta at that time. Now, if you go back to the history or the chart at that time, you will find that the stock at that day dropped by 13%. So those news always would affect the stock on a short term in order to drive the retailers out of the markets. And that time, at that day, the price went down by 13%. It went down to $440 more specifically at that day. Today, the stock is $725. And that's an increase of 65% on the same share, which at that time went down by 13%. Now it went up by 65%. Guess who benefited from that move? Institutions, institutional traders, those people who drove the agenda. And like that, you can apply it all the time. You can scale it on every stocks and financial markets news that you could hear on the CNN or on the Wall Street journals or wherever. Why I'm bringing this story to your attention today is don't rely on the news. The news would drive the market for a very quick short term, maybe one day, maximum two. Based on my experience, I haven't seen the news affecting any stock more than 24 hours. And then the market takes on its own momentum. So always reinvestigate the fundamentals of what you're doing. Always have a strategy by understanding how the momentum and the dynamics of those asset classes that you're working with are affected. Do not rely heavily or only on what the news is saying. Remember that those news are being paid agendas by the institutions to drive the price to where they want it to be. So if you hear a great news about the stock, rest assured this stock is going to increase like 10-15% at best, and then it's going to have a crash within a very certain period of time because the institutions wanted to sell their positions, right? If there's no buyers for their positions, how can they sell? And when we're speaking about institutional sales, we're not speaking about 10 shares here or 15 shares there. We're speaking about millions of shares that they want to liquidate. And the other way around, when you hear a bad news about the stock or a bad news about the coin, and here I'm speaking about the established coins, I'm not speaking about meme coins and stuff like that, which by the way, I don't believe they are investments. They are good for day trades. Let's focus back on the main topic. So if those news are tackling a stock that in a negative way, most probably this stock is gonna drop in value on the short term for one day, maximum 2 days. I haven't seen that happening for more than 2 days, literally. And then the rally is gonna start afterwards. Given that you have done your investigations on the stock, you are trusting its fundamentals. Just to keep it easy for you, I don't want to go into a heavy fundamental analysis course right now. Just to speak about fundamentals, the best way to know if the company is going to be doing well in the future, check two factors. One, what is their cash compared to their debt? how much cash do they have compared to their debt. If they have enough cash more than the debt, they could be on a healthy position. The second thing is observe their earnings for the last 2-3 quarters. If their earnings has been delivering sustainable dividends for their investors, or their earnings are increasing, which you, if you want to look for it, it's called EPS, earnings per share. If you see a stable increase on those earnings, it means the company is healthy, it has a good market share, is delivering good, it has a good balance between the revenues and their operation costs. So those two bottom lines figures can give you a good hint about the fundamentals on the company. This is without you starting to go into the macros. Let's say everything is in line. Technology sector is good. If you're looking into technology, or the healthcare sector is good, or whatever it is, then you would understand that this company is going to be doing great. You don't need to follow the title, or you don't need to follow the news titles, because most of them, and they will be using terms like may, words like may or can. They are never certain. In their titles, it's never certain. So whenever they have those may and can or would or could, this is a media news trying to create a market for the institutions. Be ready to take the opposite directions and imitate what the institutions are doing. Basically, this is one of the common mistakes that early investors do with their money when they are trying to build their own investments. So to avoid these mistakes, analyze the fundamentals, not just the headlines. Follow the institutional moves, which we spoke about it. Using technical analysis, there's a lot of strategies in the marketplace. If you already have a strategy that has been delivering for you good results, keep following that strategy. Don't change it. If you don't, I would recommend you to read some books, learn it properly. Do not apply technical analysis just from a TikTok trader or something like that. There's a lot of bullshit in the markets, and every trader has its own strategy that works for him. And maybe it doesn't work for you. Maybe it doesn't work for the market as per se, because most of the time they might have good 3 trades out of 10 and suddenly they are kings. And topic number 3 on our agenda today is finance for you and the family. We're gonna allocate our 8 minutes on this and talk about it. In the section about finance for you and the family, the specific about that is living in debt. And for some reason, in the last 5 years, given my space of work, I met a lot of families and individuals that rely a lot on debt to finance their lifestyles, to purchase certain things in their lives. Let's call them luxury things. Whether it's a vacation, whether it's a car, whether it's an MBA, whether it's a university degree, or some of them some Gucci pants or whatever it is, in order to compete on certain social standards that they don't need to compete on. Now, in the case study that I will share with you today, it happened with one, I'm not gonna give you the real name, but let's call him Ahmed. He's a good friend today, good guy that I've worked with in the last 3 years. And before we do this case study analysis, I would like you to always differentiate between good debt and bad debt. A good debt is any debt that helps you generate money on top of it. Let me give you an example. Let's say you take a debt from the bank, or from a loan on a bank, that is giving you, I don't know, charging you as a cost of borrowing of 5% per year. Let's say you got this deal with the bank and you got the 5% cost of borrowing on your loan, and you have used that money to invest in a bond or in a stock that is giving you 9% per year. Now, on the difference between the 9% and the 5%, you're earning a spread of 4% for your own benefits. This is an example of a good debt. It could be a real estate property, it could be a bond, it could be, I don't know, a stock, it could be whatever, or it could be a Bitcoin. I don't recommend that you take loan to invest in Bitcoins unless you really know what you are doing in terms of where to invest and you have a strategy where to buy and where to sell. Now, if you don't do that. But if you're taking a loan and working with it on something guaranteed, you have an expected cash flow, you have an expected termination date or maturity date, that's a good debt. But if you don't, you're increasing your risk unnecessarily. A bad debt is when you're taking those loans for luxury things that may or may not deliver. Now, when I met Ahmed, he was at the age of 38. He's a senior manager in one of the companies in Dubai, earning 55,000 dirhams. Now, in dollars, that's roughly around 15,000, no, more, less, maybe around $14,000 a month. He was single at the time. Now he just got married this year. But that time, and you know, in the banks in our region, when you earn a salary, a good position, the bank would never stop calling you to sell you a credit card, to sell you a loan, to sell you wherever. It's like you're his favorite client. And he will rank your debts up and up and up until you can stop paying. And when you cannot continue paying, your interest rate is accumulating. He is earning money on your back. And this is the position that he wants you to be. So he wants you to earn a big salary, rank a big loan from him or a big credit from him where you cannot pay anymore. The big salary will enable you for a high credit score, right? For a high loan from them. Then you cannot pay them anymore. This is the best position he wants you to ever be in it. And when you cannot pay anymore, you are gonna go and start to do some settlements with him, or you pay the minimum on your credit card or in your loan or whatever it is, and he's starting to earn on your percentage of interest rates. And that's what he wants you to be. This is the position he wants you to be in. Let me just make sure. Yeah, we still have 3 minutes on this topic. So Ahmed, remember, Ahmed is a fake name. I cannot tell you who the real person is. He purchased a home in Damak residence at 1.5 million dirham. Let's consider this as a good debt, okay? Damak residence is in downtown Dubai. Now, this is another point I want to tell you. Not every real estate in our area works. So he purchased it in 2021. Today, when we want to sell it, we are not finding for him an ask or a bid above 1.2. So even after the rally of the market in Dubai, that property is still undervalued compared to what he bought it before. Now, we're not going to discuss in depth about the tricks of the property markets in Dubai and how they inflate prices, and then how the investor thinking he's doing the right thing because we think always the real estate property is going to appreciate. We're not going to go into that today. Maybe on a later episode or in a later discussion specifically about the real estate markets in Dubai, we can talk about that. But yeah, the concept here is not every property works for the best of the investors, and not every price is the best. There's a lot of tricks that are happening in Dubai about property markets. Now, in the case of Ahmed, he bought his property at 1.5. Today, even after the rally, his property is valued about 1.2 million. So he already lost the valuation of 300,000. And he's still ranking, at that time in 21, he was still ranking about 980,000 dirhams in debt because he deposited, sorry, at that time it was a little bit more, 1.2 million, because he deposited 300,000 the down payment. So when we first met, he was having 1.2 million dirham debt. Today, the value of the property is 1.2 million dirhams. He was having a car loan because we love big cars in Dubai. He bought a Toyota Land Cruiser at the time. It was a debt of 180,000. He also paid 36,000 as down payment from it. So right now, imagine total debt, it's around 1.4 million. Credit cards, total maxed, 3 credit cards. As I said before, banks love to give us credit cards in Dubai, especially where we have an employment. Each of them, if you look into the APR, and here we need to understand the difference in the how to calculate the interest rates on credit cards in Dubai. Yeah, they tell you the interest rate is 7% or 8%, but if you look at the actual interest rate when you calculate it on an annual, one of his credit card was ranked around 24%, the second was around 22%, and the third was 18%. And his total debt on each of them was 190,000. So this is already 1.6 million dirham in debt. He earns a nice salary, and the bonus, I think if I remember correctly, his bonus was around 100,000 a year and a good salary of 55,000. Yet he has a very heavy, expensive lifestyle. He likes to, at that time, he was spending like 6,000 dirhams per month between, the Starbucks coffee that we drink on the. So the habits that we all have, a Costa coffee or a Starbucks coffee every morning or every other day or under the office. We love to have that lifestyle. I'm walking into my office with a Costa coffee or a Starbucks, yeah. Plus the dining outs, because the easiest thing is to go down, have a sushi under the office or wherever it is. It's healthy, yeah, every day, yeah. It accumulates. And we love to travel in Dubai. On average, I haven't met yet anyone from Dubai who doesn't travel at least 3 times a year or minimum twice. So that could accumulate to another 4,000 dirham per month in terms of expenses. Yeah, so as a budget. People, when they start dating in Dubai, they start giving gifts, expensive gifts. Like gifts that you wouldn't give to your wife sometimes unless you're in the first, second years of marriage, first, second, third. But expensive gifts like watches, bags, and stuff. Why? So there was a very big budget between dating gifts and stuff, and his own fashion style, branded clothes, wherever. On average, when we accumulated, it was around 3,000 dirham per month on his expenses. Plus, the personal trainer. His personal trainer cost plus his gym was around 2,005 dirham, 2,500. Clubbing, around 4,000 dirham per month. Everybody needs to go clubbing on Friday evening in order to discharge the week event. We get stressed during the week, then we need to go out for especially brunching and clubbing on the weekends. So in total, his lifestyle was costing him around 22,000, and the rest was being paid on his debt. We needed to take a pivot, radical decision in Ahmed life in 22. And the first objective was to control his spending habits. We targeted to reduce his spending habits. We still didn't speak about accommodation here. You noticed? We didn't speak about petrol bills, telephone bills, stuff. I just gave you some of the highlights that we focused on. The first thing we worked on was to control his spending habits and reduce this unnecessary, I'm calling it luxury, but it's unnecessary expenses from 22,000, and we decided to bring it down to 8,000. Remember, this is just things that he doesn't need to pay. He can live without them. We kept the accommodation as it is. We didn't downgrade. We kept his car. We didn't downgrade. But we decided to focus on reducing those expenses and change his lifestyle. And second thing is, second objective was close the debt. Close those ranking high credit card. And there's a nice concept here, which they call the avalanche. I'm not the inventor of this concept, but it's a concept that we used. And it's a very nice concept where you start targeting your credit cards, close them one after the other by focusing on the most expensive one. So if you remember when I gave you the scenarios of his credit cards, one of them was 24%, 22%, and 18% cost per year. So we closed the first one, which was 24%. Then with all the extra money that we saved from the lifestyle, yeah. So we closed the first one in around 4 months. Then we targeted the second one, we closed it while keeping on maintaining the payments at minimum for the other two. And then we moved to the third one. After we closed the second one, then we moved to the third one and we closed it. We didn't manage yet to sell his property in the Mark residence. We managed to find, those, what you call them, the holiday homes, kind of Airbnb kind of style. The property is over there right now. It's generating for him is around 8% per year. And one of the problems in that investment was it's ranking a very high service charge, which it's called maintenance service charge when you own a property in Dubai. So between his mortgage and the service charges, right now the Airbnb is kind of covering that cost until we find a way to sell it at least at the break-even point and try to find a better use for his money. Because to park 1.5 million dirham in a real estate that even in its best time it's not generating, really it's not the best use or leverage for the money. So today in Ahmed case, now we started working after we closed all his debts. First close the debt, don't live on debt, guys. We changed the lifestyle, we closed all the debt, and we started building a portfolio for his retirement and his financial commitments. Now that he has a wife, he's planning for kids in the future. So he started worrying about the future in terms of, okay, what can happen to me? And this can happen very easily in the Middle East. What can happen to me if I lose my job tomorrow? Where's the safety net that I've built? How many people do you know that came and worked in Dubai and they go back to their countries holding nothing in their hands? It's a lot. I've met a lot of people that go back, they spend 5, 10, 15 years, wherever, and they go back to their countries with maybe the last 2 months of their salaries, maybe, or the end of service. They haven't built for their futures. So one of the concepts that was missing in our education being raised here in the Middle East is who's gonna take care of us when we grow. We used to rely on our families, yeah, like our brothers, our sisters, our kids. And we come out from a family concept where the kids are gonna take care of the parents in the future. Maybe a piece of land here, maybe a showroom there. But yet, with the increase in cost, now kids cannot take care of their parents in the future how the older generation used to. When, let's say, the my grandfather used to have 12 kids, and when the 12 kids grow up, they can't take care of him between themselves. Right now I have 2 kids, yeah, and I know that when they grow, the cost of living, unless they have their own businesses or their own investments, the cost of living is going to be heavy on them for them to support me. So the question that I ask Ahmed and I ask myself every day, what have I done in order to be ready for that day when the kids cannot support me? And we have to always be ready for that. We don't want to rely on the kids to support that. We want to have a seed fund for them when they are ready to take life on. At the age of 18 or 17, maybe they might decide to go to university, or maybe they want to have their own business at the time, or their own startup, and wherever. You might need to have a seed fund for them to do whatever they want with it. So these financial commitments, we plug them into the future. Yeah, you want to buy a house, you want to have a seed fund for the kids, you want to have a life where you retire at the age of 45 or at the age of 50, whatever. Everyone has its own objective. Yeah, so by that you have a figure, which we call them, let's call them the magical numbers. You know those magical numbers, and then you have the timeline from now until that time, and you start building from them. So in Ahmed's case, now we started building this. I know we still have 8 years now to build it for him because he's planning to retire at the age of 45. Now it's gonna be a challenge, but we can do it because thanks God he have a good salary, he have a good bonus, and finally he's in the good spending habit, let's call it. He still enjoy a nice lifestyle, but we have reduced that, and he's having this apartment that could cover, it's covering itself for now until we find a way to pay up the mortgage, which is still around 980,000. By the way, if someone wants to buy that property, no, guys, I don't want you to buy that property. Let's let the real estate broker find the property for it. Now, this was the topic about finance for you and your family. That was the section on that. In its recent article, The Economist last week has, it has many articles, so we go through them. And by voting, we have the best article for the week to discuss with you on this podcast. And in the most voted article was how AI is helping tackling crypto crimes. And I'll take this opportunity here to highlight one of the most common concepts in crypto scams that is happening around the world today. I heard a lot about a lot of scenarios that happened here in Lebanon, a lot of scenarios that I've seen in Dubai. Now, when we're speaking about this concept, it's called the pig butcher. Now, when I say the concept, the pig butcher, what is the first image that comes into your mind? Think about it with me. When we speak about the pig butcher is the idea of fattening the pig until they take him to slaughter. Yeah, it could, you can take a pig, you can take a lamb, you can take, I don't know, a turkey. So most of those scammers promising, especially on the crypto space, and it's much faster and much more common of the crypto space because specifically it's a hype, it's easier access, it's not as easy traceable as the paperwork or paper investments, let's call them, and it has communities all around the world. So the scale up of those scams is much bigger than scams in a region happening in one village or one city or wherever. So those investments works in this way. They promise their investors high yields. I've heard examples like 3.5% per month, 4% per week, different scams, different schemes, but the concept is always the same. We give you, I don't know, let's say 2% per week, you give us $100,000, and they challenge you with those numbers. Like some of them are 10,000 because the scale is bigger. So whatever is the amount, or $1,000, we give you 3% per week or per month or whatever. And the concept is people want more money in a faster way, and because it's crypto and they know that crypto is more volatile, it can generate such returns. People are easily falling for those scams. They transfer the money, they might receive the dividends on 1 week or 1 month or whatever it is, and they start becoming encouraged and more engaged with the community. They add more money, they bring more friends, and like that the pig gets fatter and fatter, and then the scammers slaughter them and they start moving the money into other asset classes, into real estates, into arts, into whatever. And this type of scams or frauds, which we're calling them, it's the same style, the same concept, the pig butcher. Yeah, so they fatten the pig, and I'm using the term pig butcher because this has been the term on the FBI news, or how it was written in the Economist. And it's the same concept since history. It's nothing new. They promise higher yield, they fatten the pig, they slaughter the pig. Right now, with the use of AI, the FBI and other investigations bureaus, they started tackling down, and the last Ponzi scheme was uncovered. It was in the Middle East and Asia. It was run by a Chinese. It helped them tackle $2 billion, which is amazing. Now, what I recommend you to do, guys, one of the good things that whenever I'm investigating a case for my clients or my investors, I use a couple of tools that help me investigate those cases or those opportunities. The three tools that I'm gonna share with you today, they are called, one of them is called chain analysis. Maybe you've heard about it. They are available online. You just go in, put the scam or put the opportunity and check it. It will, or which blockchain they are using. And then you can investigate a lot of more data. It helps you gather more chatter from the internet, from the social media, from the communities on Telegram, and gives you a little bit of more, some kind of a score for the opportunity, and then accordingly you can decide what to do with it. So you can use chain analysis, you can use elliptic, and you can use Xeon. So save those for you. And most of the hedge fund managers and banks and regulators are using those tools to flag any illicit transactions. And look, if you one of the patterns that you would see when there are trend, when there are scams, you would see a lot of, let's say, wallets transferring monies with a lot of high frequency, let's call it high frequency transfers, small amounts, high frequency transfers into some centralized wallets. So when you see those patterns, you need to understand that there is something wrong over there. So always try to investigate them when using those those analysis that helps you track on the on-chain. You can also use some other tricks for the off-chain or some other tools for the off-chain intelligence. This is what these people use. Social media tracking, Telegram groups, and dark web marketplaces. It helps you understand more the depths of those scams. Now, we're not all experts in those forensic affairs, but this would at least help you protect your capital as a retail investor. As a retail investor, it's your responsibility to protect your own money first, right? And then grow it. So to protect it first, use and learn how to use elliptic chain analysis and Sion for yourself. Now I'm gonna share with you how we are using AI in the decision making. And how we are enhancing our financial analysis with it, especially by designing AI agents. And I'm going to share with you some of the top funds that are using AI. For our case, we use it on our own scale. How we've designed the agent on ChatGPT. I haven't yet explored the agents on DeepSeek or stuff. I have been loyal to ChatGPT since almost 3 years now. The concept of using AI into decision making and financial analysis has helped me reduce the time. Usually, when we want to evaluate an opportunity for an investment, especially if we're speaking about secondary market investment, here I'm not speaking about private equities or art pieces or real estate or wherever. Here I'm talking about buying a stock on whatever platform, interactive broker or an ETF or whatever it is. How do we use AI to do that? Yeah, you can go on ChatGPT and tell him, help me design blah, blah, blah. But ChatGPT is equipped with what it already knows. It's not equipped with something unique to your own strategy, to your own analysis, to your own objective, right? To also, if you want to hold that stock for a short term, mid term, long term. And when I'm saying here short term, we're speaking 6 months to 1 year. I'm not speaking day trading, guys. Here we're speaking investing. Yeah. So when we're speaking about long term, we're speaking, let's say mid term. Sorry, it's, let's say, up to 2 years. And if we're speaking about long term, and yeah, more than 5 years on a financial cycle is too much for a long term, really. And because things can change a lot dramatically, especially in the age of today. Many companies can go bust and many companies can present much higher opportunities for returns. So the way we're using AI is really by starting from the macros and drilling down to the micros. And in the past, this job used to take us around 3 weeks, literally around 3 weeks to generate those reports in order to do the analysis. Now, because we have built our own GPT models, we can click this every day morning, tick tock, we have a result, tick tock, we have a result. In the past, a large team of 6 people and time in order to generate those results. Now, with ChatGPT, we have taught a model to analyze the macro analysis for us. And when we're speaking macro, we're not looking into the S&P, how it's performing alone, or the interest rates alone. By the way, guys, interest rate is not a leading indicator, it's a lagging indicator. Let me explain. A leading indicator is an indicator where you can use it to speculate where are we in the economy and where are we heading in the next 3 to 6 months, because we're always in that cycle, right? So today, just to give you a summary, today we are in the boom session of the economy. We still might present some good opportunities for rallies on certain sectors. We're not yet in a recession. We are not experiencing a slowdown, but we have taught GPT to help us analyze certain lead indicators. ChatGPT to help us analyze the lead indicators and to analyze also the lag indicators. So the lag indicators help us understand where are we in the economy today, because they are in synchronicity or in synchronization, forgive my English, they are in synchronization with the economy of today. So this is how we use the lag indicators. And when we speak about lag indicators, definitely we're speaking about things like GDP, things like employment rates, things like non-farm payrolls. So these helps us understand where are in the economy today, but they don't help me understand where are we heading in the economy. Are we gonna still see some increase, or are we gonna see some concentration in the economy and then a drop? These are not the job for that. When we're looking for lead indicators, this is when we're looking at the earning reports. This is when we're looking the sentiments in the market. And we create a score with those AI models in order to understand where are we. And based on that scores, we have still nothing is guaranteed in this world, right? When we're speaking finance, there's always change, there's always news, there's always whatever. So we are trying to do always our best to understand, based on the information that is available in our hand today, to have the best speculation and the highest probability for that speculation of where the economy is heading. Now, guys, I want to have some fun with you here, and for the crypto fans among you, forgive me for what I'm gonna say, but what I'm gonna say is almost applies about everything in the market. People don't know nothing, honestly. Like, if you take it from JP Morgan to Bloomberg to UBS to the bank next to you in your hometown or wherever, they don't know nothing. And yesterday I was having, the notifications that comes on the screen of your mobile, like one analyst, XRP is gonna go to 35,000 or whatever, $35, let's say, per coin, and another one is XRP is gonna go to zero. On the same screenshot. I wish I took that screenshot. I was laughing. And in reality, it's always like that. Investment houses don't know nothing. No one can predict what the future is. They can align the signals, or they can align their models and have certain idea about what the future gonna be, right? And then they are gonna do their stress analysis to design their portfolios or make their investment decisions ready for this scenario and ready for that scenario and ready for this scenario, whatever are those scenarios. And like that, they are gonna try to, if let's say there is a recession, they will change like that. If there is a rally, they will change like that. But there is not one solid formula until today. Now with the increase of use of AI in the future, this might change. But until today, we are using the AI to help us predict as much as we can, or speculate as much as we can, by aligning more and more the signals and interpreting that data, millions of data points, things that we couldn't use in the past at that speed. We could use all those millions of data points for different model analysis to speculate to the best we can. Now, why I'm saying with the AI in the future, this could change, because AI could start designing the markets the way they want it. Instead of relying on the engagement of the retail markets and the institutional markets, the activities of buying and selling, the fiscal policies of interest rates or inflation rates or whatever, in the future, AI could already design that and drive us into those directions. Now, this is not the case today. Today, we're using the AI to the best we know to help us analyze where we are in order to predict what's going to happen in the future. So, this is words worth investing in. It's a quote, like quote of the day or quote of the week. Yeah. So, for us as investors, we like to use the word words worth investing in. And the quote that I've selected for you today is from a hedge fund manager called Robert Arnott. And the word that he used was, in investing, what is comfortable is rarely profitable. Now, I'd like to think with you about this concept. And in reality, this concept, it's a double-edged sword, and it can be applied to many things in our life. Now, When comfort takes over our life, and not only in investing, later on we will take it to the niche of investing, but in everything, in exercise, in lifestyle with our families, in being an entrepreneur or not, creating a new project or not. When comfort takes over or laziness takes over, we end up in mediocrity results. No one loves to be mediocre. Maybe some people are born to be mediocre, but many of the people that I know in my life are always ambitious. They are always trying to improve or trying to beat the game that they are in. Whether they are like I know people or I met people among my friends that are just finishing graduation or just quit university, some of them, and some of them are really high up at the age of almost retiring at the age 65, and some people have retired at the age of 38, but they are always trying to beat or perform the best that they can in the field that they can. Now, one common trait among all those people really was comfort is against their DNA, it's not in their formula. And when I try to match those observations of people that really don't sleep, trying, when they have an idea burning in their mind, I don't want to use other words, so let's put it burning in their minds. When they are literally on that edge with their adrenaline going on, with the excitement going on, with the trying to learn what is required to deliver that project, or trying to learn to that skill to deliver new results or design a new lifestyle in their life, comfort is out of the window. Now, when they achieve certain results, comfort starts coming back. And this is when the balance game becomes a trick, where if comfort takes on us for a long period of time, mediocrity results will start hitting, while always finding the next challenge. Whether if you're exercising, let's say if you could do 12 push-ups, now you can do 15, you challenge yourself to 18, you challenge yourself to 20, your body will keep evolving. New muscles are broken, new muscles are rebuilt, new strengths, new frontiers are uncovered. If you could run for 1 hour, maybe you could try 1 hour and a half. Here I'm speaking about exercise because it's an easy language to speak with everyone. Now, if we're speaking about a little bit more financial terms in terms of business operations, let's say if last year expenses in your business, whatever business you are running, was, let's say, if you compare the operational cost to the revenue, if it was 70%, maybe next year you want to make it 65%. Maybe the year after you want to make it 60% by reducing your operation costs and increasing the revenue. So the profit for every business is reducing the costs, increasing revenues. Yeah. So you need to always, the struggle is always find a way to do that. It could be the integrations of AI, it could be the integrations of changing the team, the age of the team, reducing the insurance costs, whatever it is. There's endless ways of reducing costs, yeah? And increasing revenues by adding sales team, implementing new AI agents on the social media, wherever it is. Now, when we're speaking about investing, imagine you were in the age of 2008, 2009, when the markets were crashing and the whole titles. Now we go back to the original concept of our idea today, early investor mistakes, where the whole titles on the news is the markets are red, we are in a crash, this is the end of days, and what are we doing next with the markets? Now, when we are at that stage, who's gonna buy? Only true investors, only people who knows what they are doing, they would invest in that market. So imagine you have bought in 2008, 2009. Now, something I'm going to share with you. Between 2008 and 2009, when the market went down, they rallied from 2008 until the year 2020, beginning of 2020, just in the period before Just in the period before COVID, the market went up by almost, if I remember correctly, between 2008 2009, the market from the bottom, yeah, I'm talking here from the bottom. The market all the way till 2020 went up by almost 400%. Feedback successful. Almost 400%. Imagine you have both at the bottoms, and here I'm talking just the simple S&P 500. Imagine you have put your money in an S&P 500 ETF and waited for it for those 11 years. Yeah. Now, between the bottom of 2020, we're going to have later on another observation. Between the bottoms of 2020 all the way to the peak of where we are today, let's call it, the markets are already up by around 189%, which is great. But who got the balls to face the uncomfort of those days in order to invest? The concept is when the markets or the investment opportunity sounds uncomfortable, go for it, lean in. Or the business that you're leaning into it is uncomfortable, lean in. And because growth comes from uncertainty. Growth comes from uncertainty. Now, I'm not telling you go and invest in things that are scams, when that's not the comfort or the uncomfort that we're talking about. The uncomfort we're talking about is when the markets are crashing, people are running away, blood in the streets. This is when you go in. This is when you lean in. Well, this brings us to the end of our session today. Our podcast, this was podcast number 3 for you. I hope you will enjoy it and benefit from it for today and for the future. And do not hesitate to put any question you have in the comments or certain specific topics you would like us to discuss. Stay tuned for next episode, and thank you very much for listening. Bye-bye.